Welcome to Talk Tickers. We're diving straight into the numbers and the narrative behind them. Today, it's Oscar Health's Q3 2025 earnings call.
Right. And this one was, interesting. A lot of moving parts. Our job is to unpack that raw data, the management talk, and what it all means going forward.
Essential stuff, especially given the market's reaction. It was all over the place, big pop pre-market, then a pretty sharp drop by the close.
Exactly. So let's get into it. We're aiming to give you that critical intelligence.
Okay, let's kick off with the headline numbers. They immediately set up this tension. Revenue hit $2.99 billion.
Which, sounds great on its own. That's 23% year-over-year growth. Solid.
But, and this is the key, it missed the street consensus. That was nearer $3.14 billion, so a miss there.
Right. But then you look at the bottom line, GAAP EPS was a loss of 53 cents. Still a loss, obviously.
Red ink, yeah.
But it actually beat the consensus estimate, which was looking for a loss of around 57 cents. So a bit better than expected on profitability or lossability, I guess.
Oh, yeah. And membership looks strong too, right?
Very strong. 2.12 million members. That's up a huge 28% year over year. Really significant growth there.
So, okay, revenue miss, EPS beat, great membership. How did the market first take that mix?
Well, initially, the reaction was pretty positive, very positive, actually. That EPS beat, combined with management really doubling down on their 2026 profitability target, that sent the stock soaring pre-market.
We saw jumps of, 7, 8, even 10%?
Easily. But then as the trading day wore on, people started digging into the, let's say, the operational guts of the report.
And the enthusiasm pooled.
It vanished completely. Once traders chewed on the details, especially around costs, the picture got a lot murkier.
Which brings us right to the main issue, the medical loss ratio, the MLR.
Yeah.
That's the core metric for insurers, yeah. How much premium goes to actual medical claims.
Exactly. And in Q3, Oscar's MLR clocked in at 88.5%.
Oof, that's up, about 380 basis points from last year? That's a big move upwards.
It is a very significant increase. And management was pretty clear about why.
What was the main driver?
It was a specific item, a $130 million increase to their risk adjustment payable for 2025.
Okay, $130 million for risk adjustment. Let's unpack that a bit. What does that actually mean in plain English?
So management said this was because of higher market morbidity. Basically, the overall pool of people in the ACA market they serve got, sicker.
Sicker? How does that happen?
They pointed directly at the ongoing Medicaid redeterminations. As states check eligibility, lots of people lose Medicaid.
Okay.
And the thinking is the folks who lose Medicaid but really need insurance, often those with more health issues, they're the ones most likely to jump over to the ACA exchanges, like the ones Oscar operates on.
I see. So the influx isn't just volume, it's a shift in the type of member, bringing higher average costs.
Precisely. This higher morbidity means Oscar owes more into the risk adjustment pool to balance things out across insurers. That $130 million is the direct hit from that trend in Q3.
So it's kind of an external pressure driven by policy changes impacting the whole market.
That's how management framed it, yes. An external headwind. Now, the market might still ask if they should have anticipated it better in their pricing, but the underlying factor seems real.
Did they have anything cushioning that blow?
They did mention about $84 million in favorable prior period development. Basically, they'd overestimated claims from previous quarters, so they got some money back, so to speak.
Okay, so a bit of good news from the past, upsetting some bad news in the present. What about the actual usage trends? Like, are people going to the doctor more?
It was a bit mixed there, too. Inpatient use, so hospital stays, was still elevated. But they did say it was moderating through the year, which is somewhat encouraging.
And outpatient, doctor visits, procedures.
Just slightly elevated as well. Pharmacy costs, though, were favorable, so they seem to be managing drug spending relatively well. But the main pressure point really seems to be this overall market health profile, the morbidity thing.
Right, so MLR is the big headache. To keep that 2026 profit story alive, they needed something else working really well. Where's the good news operationally?
It's all about SG&A, sales, general, and administrative costs. That's where they're executing.
Their efficiency metric.
Exactly. The SG&A expense ratio dropped nicely, down about 150 basis points year over year, hitting 17.5%.
That's a solid improvement. How are they doing it?
Management credits two things: leveraging their fixed costs over that growing membership base, spreading the overheads, and just disciplined cost control. Good old-fashioned belt tightening.
And this puts them on track for their longer-term targets.
Yes, they're aiming for around 16% SG&A ratio by 2027. So 17.5% now shows good progress towards that goal. They seem confident they can get there.
Are they using tech to help drive that? I think I saw something about AI.
They did highlight that, yeah. A new AI agent they call Oswell. It's built using OpenAI's tech.
Oswell, okay, what's it supposed to do?
The idea is to streamline things. Integrate data from claims, medical records, notes from their care guides, basically make operations smoother and ultimately cheaper.
Is it real operational leverage or just, the latest buzzword?
Time will tell, of course, but management positioned it as a key part of their strategy to hit that 16% target. If it helps them handle member interactions and admin tasks more efficiently, it could be a genuine edge. The SG&A numbers so far suggest they are finding ways to cut costs.
Okay, so this SG&A execution story is crucial. It's the counterweight to the MLR pressure when investors think about that 2026 profitability goal.
Absolutely. And despite the Q3 revenue miss and the MLR spike, management sounded, well, pretty firm. They remained confident, was the phrase used.
And they reaffirmed the full year guidance for 2025.
They did. Revenue expected towards the low end of the $12.0 to $12.2 billion range, and the loss from operations somewhere between $200 million and $300 million.
So sticking to the plan, that reaffirmed guidance plus the 2026 profit promise must be what initially propped up the stock price.
That was the narrative holding it up, yes. The belief in the future execution.
Now, to make that 2026 profit happen, especially with higher costs, you must have priced pretty aggressively for next year, right? What's the plan for open enrollment?
Aggressive is one word for it. They're implementing a weighted average rate increase of roughly 28% for 2026.
Wow, 28%, that's huge.
It is. It signals they're taking the higher trend and this market morbidity very seriously. And crucially, they priced as if the enhanced premium tax credits, the government subsidies, will expire at the end of 2025.
They built that assumption in. That's a very defensive posture.
Yeah.
What if the credits don't expire?
We'll get to that. But yeah, they're pricing for a tougher environment. It assumes some members might drop off if subsidies disappear.
Where are they offering these significantly more expensive plans?
They'll be in 20 states. That includes new launches in Alabama and Mississippi. So still expanding footprint, but carefully.
And any new products to maybe attract different types of members?
Yes, diversifying there too. They announced Hello Manow.
Hello, Manow.
Yeah, specifically tailored for women over 45 in the ACA market, focusing on needs around menopause. It's a targeted play for a specific demographic.
Interesting niche.
And they're also pushing further into the employer space with a new plan called High Health with Oscar. It's an ICRA plan starting in Des Moines, Iowa.
ICRA. Remind us quickly.
Individual Coverage Health Reimbursement Arrangement. It lets employers give employees tax-free money to buy their own individual plan, like one from Oscar. It's gaining traction, especially with smaller businesses.
Got it. Okay, let's shift gears slightly to the balance sheet. They made a move with their debt that seemed to spook the market a bit. The convertible notes.
Right. They did a partial exchange of their 7.25% convertible notes due in 2031, swapped about $187.5 million of the debt principal for roughly 23.3 million new Class A shares.
So less debt, which means less interest expense down the road. Sounds good.
The goal is sound, yes. Cut future interest payments, simplify the capital structure, but the cost is dilution. Issuing over 23 million new shares waters down the ownership for existing shareholders.
And the market hates dilution, especially for a company not yet profitable.
Exactly. While the long-term benefit of lower interest is real, the immediate reaction tends to focus on that dilution impact, especially when profitability is still, a 2026 story.
So that dilution fear, combined with the 88.5% MLR, that explains the big reversal on the stock that day, November 6th.
That seems to be the dynamic. The pre-market pop was all about the 2026 promise and the EPS beat. But the close, down almost 3% on triple the average volume. That was the market wrestling with the current high costs and the dilution from the debt swap.
A real tug of war between the future story and the present reality.
Perfectly put. Management pushed the cost control and 2026 narrative hard. But the market focused on the MLR number right now and the fact that more shares are out there.
The CEO also tried to frame things in a broader policy context, didn't he?
Sure.
Talking about the ACA market itself.
Yeah, emphasizing how vital that market is. 22 million Americans rely on it. And they used a pretty stark example about the impact of those enhanced premium tax credits.
What was the example?
They mentioned a farmer making, say, $60,000 a year. With the current credits, their premium might be around $75 a month. Without them, it could have been $300 a month previously.
That's a massive difference. Really highlights the importance of those subsidies for affordability and keeping people insured.
Absolutely. It underpins the stability of the whole individual market.
So looking ahead, what are the key things investors should be watching for Oscar over the next, say, 6 to 12 months?
Number one is the results from this current open enrollment for 2026. Did that huge 28% rate hike work? Did they keep enough members? What's the mix look like?
Okay, OEP results. What else?
Then we need to watch the risk adjustment payments and receivables as they get finalized early next year. Does that $130 million Q3 accrual prove accurate, or does it change? And obviously, the Q4 results will be critical, as they should give the first real glimpse into the 2026 financial outlook.
Makes sense. All right, before we wrap, let's do our This Is Not Financial Advices segment, just a hypothetical trade idea based on all the tension we've discussed. And seriously, folks, not advice.
Definitely not advice, purely a thought experiment. The core idea comes from that gap. Management's confident 2026 story versus the market's current jitters about MLR and dilution.
So how could someone, hypothetically, play that tension? Bet on the long-term plan, but protect against the short-term bumps.
Okay, so one way to structure it could involve options. You're targeting that 2026 inflection point. So part one, go long, buy the 2027 EPS, the long-dated call options.
Betting on the turnaround materializing by then?
Exactly. A leveraged bet that they actually hit that 2026 profitability and the stock re-rates significantly higher over the next 18 months or so.
But that's risky given the current MLR and execution questions. So part two, the hedge.
Part two is the hedge. You could simultaneously short a small amount of the common stock. The idea here is to capture some premium or offset some cost, betting against the near-term drag from that dilution concern and the high MLR noise.
So long calls for the big picture win, short stock to hedge the immediate worries.
Kind of. It's basically betting that management pulls it off eventually, but acknowledging the path there might be rocky and trying to cushion some of that short-term pain or uncertainty. A structured bet on execution.
A complex play. Definitely for experienced folks only, if at all. And again, not advice.
Not advice. So just to recap the core situation here, Oscar's got this real operational challenge with the higher MLR driven by market morbidity, probably policy related.
But they're countering that with pretty impressive SG&A savings, leveraging tech, and they're sticking firmly to that 2026 profit goal, backed up by that massive 28% price hike for next year.
That's the tightrope they're walking.
So here's the final thought for you, the listener, to chew on. Management priced those 2026 plans assuming the absolute worst on subsidies, a 28% hike, anticipating market shrinkage if the tax credits expire.
A very conservative assumption baked into the pricing.
Right. So the provocative question is, what happens if Congress does extend those enhanced premium tax credits, if that policy headwind they priced for just disappears? How much extra margin, how much potential profit buffer is actually hidden inside that 28% rate increase?
That potential upside, if the policy environment turns favorable, that could be significant.
That's the question that might define the next 6 months for Oscar. Something to think about.
Absolutely. We hope weaving through these details helps you form your own perspective. Thanks for diving deep with us.